Hi, I'm Colin Campbell, and this is PwC's Tax Insights in Brief. Treasury and the IRS released Notice 2026-7, which provides additional interim guidance on the Corporate Alternative Minimum Tax, or CAMT. This new guidance builds upon a series of recently issued Treasury and IRS notices and is expected to significantly reduce or eliminate CAMT liability for many corporations. It accomplishes this objective by introducing and expanding several adjustments used to compute Adjusted Financial Statement Income, or AFSI. These adjustments harmonize several book tax mismatches, including those arising from tax repair deductions, eligible intangibles, such as acquired goodwill, certain domestic R&E expenditures, qualified production costs under Section 181, and eligible materials and supplies. This notice also reinstates important protections for financially troubled companies emerging from bankruptcy. It right-sizes the anti-abuse rule for certain covered asset transactions involving foreign corporations by providing a more flexible rebuttable presumption, and it addresses certain CAMT consequences of Section 367D transfers of intangible property. Here are a few key takeaways for taxpayers. First, the notice closes significant gaps between book and tax treatment across several high-impact categories. These changes could reduce a corporation's CAMT liability and may remove the corporation altogether from the CAMT regime. Second, a new adjustment in the notice eliminates CAMT exposure associated with the OB3's options for recovering Section 174 R&E expenditures that were capitalized under the Tax Cuts and Jobs Act. However, it is important to highlight that no adjustment is permitted for R&E expenditures paid or incurred after 2024. Third, the notice broadens a key AFSI adjustment for Section 197 amortization attributable to any goodwill, regardless of when acquired, as well as other intangibles that are not amortizable for book purposes. This is a key win for M&A-focused taxpayers. Lastly, companies may rely on the interim guidance for tax years beginning before publication of the proposed regulations, subject to a consistency requirement for AFSI adjustments. So what's next? Well, Treasury and the IRS are actively working on the new proposed regulations that likely will adopt the approach of these interim notices and portions of the prior proposed regulations. Until then, corporations may rely on the notice, provided that they apply its provisions consistently, beginning with the first year relied upon. Corporations also should be aware that this notice modifies certain prior interim guidance, including portions of Notice 2025-46 and Notice 2025-49. Here are some next steps. The top line is that corporations should continue to be proactive in determining their potential CAMT exposure. And the first and best way to do that is to update their CAMT models to take into account this new notice. Modeling also will help taxpayers identify ambiguities in the current guidance or additional book tax mismatches that potentially could be addressed in these upcoming proposed regulations. As Treasury leadership continues to make policy calls for these upcoming proposed regs, corporations should consider whether to submit comment letters to highlight any of these concerns. Lastly, corporate taxpayers should continue to assess opportunities to apply new adjustments retroactively and to amend returns for 2023 and 2024 where CAMT was paid. For more details, please read the attached insight. Thank you for watching. This has been PwC's Tax Insights in Brief.